Okay, everyone, this is Module 2 in Business 900. So, Module 2 in Week 2 of the course. Oops, sorry, my bad. It's the second module I'm working on. It's Week 1 in the course. And I'm just thinking about other items on my plate, so that's the mistake. Now, of note, this module complements Chapter 2 in the Ross Westerfield Jaffe book, so I'm building on that primarily. Chapter 2, RWJ. And you can get a complete statement of cash flows kind of idea there, and especially check the section in Higgins on cash flow statements. Now, who should review this, right? So immediately, if you feel very comfortable with the concepts of financial accounting, you could probably safely skip this. If you don't feel comfortable, let's just go through the review then. And first, let's do an overview. All right, an overview. So accountants prepare typically 4 types of financial statements, right? So 4 types of statements. There might be more for some other purposes, but for our purposes, we want an income statement. We also will see them preparing a balance sheet. And we'll have a statement of retained earnings. Statement of retained earnings. Pretty common to see. And you'll see a statement of cash flows. Very crucial. As we saw from the last module, sort of bread and butter of finance is going to be the cash flows. Now, these 4 statements report what has happened in the past. Right? They're based upon past events. Their calculations are on intervals of time. And they're prepared, right, following GAAP, generally accepted accounting principles. What's more, this data is helpful because it helps us understand possible estimates that we want to put in place about what will happen to a firm in future periods of time. So we could say that if current operating and financial strategies are continued, then it's pretty sensible to rely on the historical accounting data to try to produce some forecasts. Key, though, right? Key is this term right here, if, right? If the strategies are constant. So what we're going to do in this note is take just a brief look at financial statements. How do we analyze them to see how the firm has attained its current financial position? We want to know what events are leading up to the current condition. So, right, what we're thinking about, right, is, all right, financial strengths and weaknesses that have come about as a result of past decisions. We also want to look at the financial statements so that we can make some predictions. To make predictions, right, we will rely on this data, and the predictions will be fashioned into what are going to be called pro forma statements. Pro formas are our forecasts. These are projected financial results. For financial managers, right, the future is what we really are interested in. The past is sunk, right? It is unrecoverable. You can't go back and change the past. You don't have a time machine. So we say that the past is sunk. See, right? So we want to right? We want to focus our attention on the future. Now, you could say as an example, suppose we looked at the cost of goods sold to the sales as a ratio. Cost of goods sold is often abbreviated COGS. And take that as a ratio to sales. Say that's been stable over the past few years, right? So it has a characteristic. Let's say it's been stable for several years. So we say, well, maybe that's a reasonable starting point so that we'll assume that this particular ratio might stay stable over the next couple of years too. We could say maybe it will remain stable. We have to, of course, justify this. So we could take this information and forecast, say if we had a forecast of sales, right, from that forecast of sales, we could basically forecast COGS, cost of goods sold. We could then basically forecast inventory needs. We might look at inventory turnover over the past few years. If it's constant, then we can use that to predict inventory levels. Now, I'm only going to briefly review the accounting basics. If you still feel uneasy about financial statements, then you should basically look at the financial statements chapters in both Ross, Westerfield, Jaffe. And this is always part of an early part of a finance text. Look at Berkman and DeMarzo also. And Higgins goes into this briefly as well. So you got lots of options for review. So secondly, so what do we do there? It's just an overview, right? So now what I want to do next is let's begin with the income statement. The income statement records the flow of resources over a specific time interval, right? It's recording a flow, right, of resources over time periods or time intervals. Right? How much income is being generated in a given year, for instance. Accountants, they have rules for what they can recognize as revenues. Recognition, it is said under the general rules, it occurs when the efforts needed to generate the sales have been substantially completed, and that when the title to the goods passed from the seller to the buyer. So recognition is one of the key concepts when the accountants, right, when they're able to record revenues, right? So revenues get recorded, right, based on substantial effort. Put some quotes on that, because that's a little vague. And transfer, right, title transfer from the seller to the buyer. So that's what we mean by recognition. The expenses that are required to generate these revenues are matched to the revenues following basically an accounting protocol. So expenses are matched. They're matched to the revenues that are generated. Now the protocol is known as, you might have remembered this if you did some accounting in the past, it's a protocol of what we call accrual. That's just basically a fancy name for the matching process. So there's a set of rules that are used to make sure that we're placing the data into the income statement correctly, that we're making the proper matching decision. And what we get then, of course, after we've figured out revenues and expenses, we identify earnings. Right? Famously, it's called the bottom line, right? The bottom line is the difference between the revenues and the expenses, right? So it's total revenues minus total expenses. Right, that equals earnings. Right, so this is really the essence, right? The essence of the income statement. That equation makes the whole process seem very simple. The process looks simple. Now, because there are these rules in place for classifying the accounting transactions, that's when we get things going a little bit complex and possibly mysterious. A great deal of effort goes into the construction of the properly prepared financial statement. Now we know, we've learned here that accounting earnings or profits are not equal to cash flows, right? Profits, they are not equal to cash flows. Crucial finding. Now we can see why. Let's ask why, right? So first answer is really got to do with what we call, right, the accrual accounting process. Right, accrual accounting works like this. Let's do an example, right? Let's say you have a credit sale and it's recognized as revenue. See, the cash does not materialize until a payment is made. Or expenses could be recognized, but the expenses are recognized maybe before a payment is actually made, right? Materials might be used from inventory, but maybe not really paid for at the time of the sale. See, so to obtain cash flows from the income statement, you have to make a variety of adjustments so that you account for the changes in the working capital, right? So the income statement becomes one basis, one part of my calculation work. I have to make adjustments to it. Right, so you got to make adjustments based on net working capital. That's the current assets minus the non-interest bearing liabilities. So non-interest bearing liabilities. What is that? That's a variety of items, including accounts payable, taxes payable, and wages payable. Okay. So if net working capital increases over an accounting period, that increase must be deducted from the accounting profits to establish the cash flows. So that's a general rule. If net working capital goes up in the accounting period, then, right, that you have to deduct that increase, that change, from the accounting profits. See, so say delta, so you go minus delta net working capital. So the change in net working capital has to be applied, to the accounting profits. Thus, right, of course, if net working capital were to decrease, then you take that change and add it into the accounting profits. So that you get a very accurate depiction. See, you subtract the change in net working capital from profits, and that helps you identify the cash flow, right? So subtract the change, delta, in net working capital. Let's erase that. So, right, subtract, as a general rule, right, the change in net working capital from the profits. That gives you cash flow. Now, you have to be clear on why the direction of change is as it would be stated. So you have to always remember these rules here. These are really crucial. Now, of course, there's a second reason. The second reason why the profits don't equal the cash flows, which is crucial. So put a 2 here, is what we call some non-cash charges. Right, several expenses are listed on the income statement that are actually not cash outlays. Right, the most common example is depreciation expense. The depreciation expense, right, tries to measure the extent to which the fixed assets are used up generating the revenues. Right, so there's some degree of using up fixed assets and generating the cash flow. And the way the real cash flow occurred was when the expenditure for the fixed assets was made. Right? So I put the fixed asset into place, and there was a real cash flow. Like if I spent $100 million on a project in a given year, that's an amount of cash flowing out. And now the asset began getting used by the firm. There's a variety of other non-cash charges to note that you have to write off, maybe patents. Could be, maybe you have to change what's called goodwill in the company. You might have suffered losses when you disposed of some assets. And right, if you sell a piece of machinery below its net book value, you've got a cost with some accumulated depreciation. It's called a loss on disposal. See, in a cash flow sense, no real loss occurred. There might be a tax implication, and that is real. Okay. And what we have to do is adjust accounting earnings back to a cash flow basis. So all of the non-cash flow charges must be added back to net income. That'll get me back to cash flows. There's a third reason, right? It's got to do with investments. So actual cash outlays for fixed assets, capital expenditures, right, must be deducted from the accounting income to obtain your cash flow. Okay. This is often a large cash outlay that impacts net income only really eventually through the depreciation expense. Right? So you have to take the actual cash outlay and deduct it. And then fourthly, you got issues with tax timing. We'll call it tax timing differences. Firms usually keep about 2 sets of books. One set is for the public use, so we can distribute information to shareholders. And the other set of books is kept for the Internal Revenue Service, the IRS. See, the IRS might allow the write-off of an asset actually much more quickly than the accountants believe the asset's being consumed. So the firm wants to minimize its taxes, and it will run the faster write-off procedure on its tax books but it will write the slower procedure into its public books. See, so the actual tax paid in a period may be much less than the tax expense that's shown on the income statement prepared for the shareholders. So you have to adjust accounting profits to the cash flows by looking at the accounting earnings, adjusting them for the difference between taxes accrued and taxes paid. So you add the change in the tax accruals to the net income. So add delta in the tax accruals to net income to get to cash flows. So those are just some brief notes, right, on income statement. How about the balance sheet? We saw this in brief and very, very generic terms last time. And we've heard it many times, yawn. It's the snapshot at a moment in time. Whereas the income statement is looking at flows across time. Now we get a snapshot at a moment in time about everything the firm owns and everyone to whom the firm owes money, creditors and stockholders. And the balance sheet is a very simple identity equation, right? It works out to be assets, right? And those are equal to liabilities and equity. Now, everything the firm owns comes up underneath the heading of its assets, the left-hand side of the balance sheet. Right? And the current assets will be in one section in order of their liquidity. Right? So the current assets are in liquidity order. And then you'll have a set of long-term assets. Right? So inside current assets, you got cash, typically, the most liquid, accounts receivable and inventory. The general rule is that a current asset is something that you could convert to cash or be cash, right, within about a 12-month period. Inventory is considered current assets because it can be sold and converted into accounts receivable, and then that gets transformed into cash within a 1-year period. Longer term assets are then, right, listed. They're, again, ordered in their level of relative liquidity. The assets are either tangible or intangible. The tangible assets are the current assets and all the fixed assets, things you can touch, right? Intangible assets are ephemeral. They're very difficult to quantify. They include things like goodwill and trademarks and patents and human capital of the employees. Oh, if you disallow slavery, right, then employee assets are not really owned on the balance sheet. When you're estimating the value of intangible assets, it's very difficult, sometimes impossible. The assets do, though, have a very large impact on the market value of a firm. Look at, for instance, a software firm. The firm might have very little in the way of fixed assets, but let's say it's got a team of software engineers, and they have human capital, which is really the basis of the value of the firm's common stock. So this is one reason why the market value of a firm's equity typically bears little resemblance to the book value of the owner equity. Now, the liability side, you get current and long-term as well. Pretty straightforward. Current stuff being paid within a year's time. Preferred stock is a hybrid security that has properties of debt and properties of equity, so it's sort of in a gray area. Depends on the purpose of our analysis as whether we'd want to put it into the debt or the equity category. If you were a debt holder analyzing the firm, preferred stock would be considered inferior, a kind of junior claim to your position. So you'd look at the preferred stock as equity. But from a common stockholder position, preferred stock has a superior or senior claim to the cash flows. So you might look at it and think about it as classified as a debt, possibly in equity, but it's tricky, right? The residual owners of the firm, of course, are the common stockholders, the equity holders. Accountants will list a variety of accounts under the equity section. The sub-accounts typically are, of course, the capital or common stock, any capital surplus, which is capital in excess of par value, and retained earnings. Now, those are very important distinctions typically for accountants, but they don't make much difference for us as financial managers. In total, the equity accounts are called the net worth, the book value of the firm, the difference between the total assets and the total liabilities. And remember, I just mentioned that the book value can diverge from the market cap. Fourth, let's look at the statement of retained earnings. Now, this is a simple statement that expresses the relationship between retained earnings. We'll label that RE. And we're looking at a particular accounting period, and we're looking at the ending retained earnings balance. Now, the best way to describe this is we look at the ending retained earnings. That's equal to, go back, say, to the beginning of the period of interest, probably a year. You get beginning retained earnings plus net income, right? Minus any dividends that you paid to your stockholders, plus and minus some adjustments that might be necessary. Now, accountants do not generally approve of making direct adjustments to retained earnings. And so for the purpose of this general review, we're going to ignore that last term for now. I'm going to pause for a second. Got to go do something. All right. Now we're live again. We're live, and oh no, hold, got to stop for a second. Okay. So I apologize. I hope we're going again. Let's see. Yeah, we're going again. We're live. All right, so had a problem with a child there for a moment, right? Fifth item was this, the statement of cash flows. The statement of cash flows is very critical for us to look at the firm's performance. Here's where we get our information regarding how it gets its cash and how it spends its cash. This is crucial. The income statement does not provide this information. See, so the cash flow statement is prepared to remedy the deficiencies that exist in the income statement. So a statement of cash flow is, of course, very valuable. It's a relatively recent addition to the required set of accounting statements that are prepared. Preparing and using the statements is actually kind of mind-boggling at times. Finance managers often prefer a very simplified version of the full-blown statement of cash flows, which we'll call basically a sources and uses statement. It doesn't have the bells and whistles of the full cash flow evidences, we'll say. But what's going on is the sources and uses statement is a little easier to understand. Now, to prepare that statement, recall there are three basic types of balance sheet accounts, right? We've got the assets, the liabilities, and equity. So the sources of funds arise when an asset account is decreased, right? Sources of funds arise when an asset account is decreased. So let's make a little chart. I just gave you one item. Sources of funds. Over here we'll put uses of funds. So first one is, right, suppose we decrease some asset account, right? So we decrease an asset account. The opposite would be that we're using funds if we increase an asset account. So I'll say plus asset account. Second area in this sort of sources of funds would be if we increase a liability account. Say we borrowed money, so now we have, let's say, some long-term debt, and that's a source of funds, right? So we have to see that the liability account increased. And likewise, just related to that, is any decrease in the liability account. Maybe I retire some debt. How do I do it? I retire debt. I retire the debt by using some of the firm's cash. Oops, this is account. Asset account. It's a decrease in the liability account. Still getting used to this darn pad. But hopefully it's helpful for you guys. You can give me feedback if it's workable or not. And then thirdly, right, a source of funds would be an increase in an equity account. Likewise, let's say I pay some dividends, a decrease in equity account, or maybe I buy back some shares. That's an imperfect statement, but again, it kind of goes into some of the mind-boggling elements of calculations. Now, if you look at the table, you'll note that you only have 3 rules to learn, right? Only 3 rules. I definitely want to highlight this. I want you to know this set of rules is quite important. So sources and uses have opposite signs with respect to the increases and the decreases of an asset, a liability, or an equity account. So all you have to do really is learn the sources side, for instance, and then just flip the sign for the uses side. An example might be if you saw an increase in inventory, right? So you have to think, what is inventory, right? That's an asset. So you got a plus to the asset side of an account. That means you have found a use of funds. You had to use money to increase that inventory. An increase in a debt, right, is a source of funds. Paying off debt, use of funds. It's a liability, right? Well, increase in debt plus liability, right? So you have a source of funds. Money has come your way as a result of issuing the debt. And you're going to get some review and practice in the construction of income statements and balance sheets when you look at Higgins and you work on some of the homeworks this week from Higgins. It's just little tricky questions to see if you know how to do what I want you to do. And probably one more video is coming your way where I'm going to review the construction of a financial statement. What I'll do is I'll do a, I don't know, Corporation X. And I'll give you a whole bunch of miscellaneous jumbled financial data for a given year. Throw it into Excel, and I'll point to the various elements inside Excel, and we'll try to organize the data into, well, I'll do, the income statement and the balance sheet We'll do some retained earnings, and we'll even, generate another balance sheet perhaps, and get a statement of cash flows in place, and a sources of uses of funds in place with, well, me having to construct my spreadsheet of the jumbled data first. And actually, I might go, this is up in the air. I'm not sure if I want to do it, because you do have a couple of excellent resources inside Higgins. The Higgins book I have to review, and I'll look at maybe a couple of questions in some of the chapter end sections, and I'll pick a question to review with you. I have to look, and what I'll say is I'm going to put that in the next video. It's either going to be me working, with, I'm still in week 1. I'll do one more video, for example, and a video example. I'll either do it with my Corporation X, so either Corporation X, or I'll look at Higgins. I haven't decided yet, so I'm still working on that part of it. So just keep in mind, you'll just see a kind of a worked example that you can follow. And that should be all I want to do right now for Module 2. And of course, it was just very basic, and it hopefully gives you a little bit of guidance to understand the interrelationships between these sheets. Okay? So I'm going to stop, and we'll put this up on Blackboard.